to welcome each of you who joined CBonds webinar today. My name is Lana Veselova. I'm co-head of International Department at CBonds. If you still don't know us and you are new at our webinar, so we're a data vendor of fixed income market information with 20 years of experience. In this way, we have the possibility to communicate with experienced speakers. So today's topic of our event is entitled as "Are Chinese bonds offering an attractive entrance?" So obviously today we'll speak about high yield bonds with the primary focus on Asian markets, of course. But in any case, today we'll cover global markets. We'll have the global view on the market situation today. Today, our main guest is highly experienced Chief Investment Officer and leading experts with 26-year experience, Andreas Bickel from Blackfort Capital. Andreas, if you had a chance to read his profile, previously worked in Goldman Sachs, in Deutsche Asset Management at Rothschild. So I'm sure this event would be interesting for you as our previous ones. In terms of the content, today we'll have a macroeconomic overview of the situation, basically how it changed since April, since we had probably last seminar. We'll discuss real versus nominal yields. Of course, we'll speak about sovereign bonds and whether central banks are right now behind the curve or some markets could improve the situation. And of course, we'll be more precise in terms of some particular markets and some particular issues on the Asian market and global. So feel free to ask questions. Please put them in question section. I'll pick the most interesting ones. And of course, I'll be joined with my colleague, Alessandro Lombardo. He's co-head of International Department. So today we'll also show you the possible ways how you are able to find some attractive investment opportunities in the market. What is available now. Please let me pass the floor to Andreas and be active as the most interesting questions will be discussed. So don't miss your chance to speak with amazing, wise economist. Andreas, how are you doing today?
Hi, Lana. Thanks. Good. The weather is at least not bad. That's already helpful. So let's try to dive into. Thanks for the introduction. Although you will see single bonds where you can easily act on it if you will, I would like to stress this is not intended to be financial advice. I'm not your financial advisor. And anytime you invest, you need to do your own suitability check and you need to decide yourself if that things which we are going to see is suitable or not. Having said that, let's dive into it. As Lana has already presented the agenda, basically the question is, are high yield, in particular Chinese bonds, offering attractive entrance? The reason for that is obviously straightforward. As we all are aware of, there is a huge changement in regulation in China. And therefore, the question is, are bonds at the moment priced in a way it's worthwhile taking the risk? But before that, let's start with macro, because macro and the possibility to invest in bonds is tied together. And similar to April, the story hasn't changed much, but one key element is different. We have now, with rare exception across the board, an inflation problem, or do we have a problem, question mark, according to the ECB or the Fed, we don't. Other economists, and I would call myself to the later part, we think we have here definitely a longer term issue. But let's start with the US, second largest or largest economy of the world, depending on what kind of measurements you are taking. This is the service PMI of the US. It has just hit a new record at almost 70. As a reminder, above 50 is growth, above 55 is strong acceleration, and above 60 is really a rare phenomenon, and we are almost at 70. Therefore, it is fair to say that steam in the US has picked up. This was coming as a surprise because the figures in August and September were weaker, and now we have a strong boost. This is due to opening. What I would like to stress already here is the component price paid. It has the same scale from 0 to 100, and 50 is the dividing line. We are almost at 83. So there is definitely inflation pressure from the service sector. If we turn on to the manufacturing sector, we do see that also here, the price paid component is above 85. Therefore, also a strong indication that producer price data will come, and actually have already come in much higher than previously anticipated. And also in the comments of the people who fill the survey, you see that there is an inflationary pressure because the delivery chain of input goods and also the delivery of produced goods is distorted due to COVID, due to closed ports in China. In front of California, for instance, there are like 30 ships waiting that the vessel can be unloaded, and this is across the globe. Therefore, we have a lack of input products, chips as an example for cars, but there's many more, and this puts inflation pressures. If we continue with the echo data in Europe, as you can see on the right-hand side, both data are still consolidated above 50, at the area of 55, but falling, and they keep falling for months. And in the middle, you do see that Germany, fourth largest economy of the world, France and Italy, two other very large companies of the Eurozone, they both have multi-month low levels. In Germany, all the indicators, besides the ZEW, which came out yesterday, they are all turning down. But there is one hope, that ZEW expectation index has sharply risen. Therefore, the conclusion I had until yesterday morning that the ECB is behind the curve is at least questionable. The same can be said about the Fed and a very similar statement about the Bank of England. But today's topics are emerging market, therefore let's move on. Asian PMI, so it's exactly the same metric like before. What we do see here is that Japan, one of the largest economy of the world, still has a sharp rebound. It came out of a deep hole. Also Taiwan, mainly chip-driven and technology, they are starting to reproduce and they are above 50. South Korea, based on this measurement, is having a soft patch. However, real data of export do show a surge, but we are still below the levels we have seen before the COVID crisis. And China is a mixed bag. I mean, the service sector strongly rebound, and the industrial area has had a hit. This is due to the regional lockdowns. As we speak, there is again a lockdown in China. So China is the tricky bit, and that will be the core of the presentation. What is, for me at least, interesting and surprising is that the ASEAN area, so also Asia, but particular ASEAN, you do see strong rebounds in all that areas. You might remember we have talked about Vietnam in April. It's more on the equity side, but There, the amazing bit is A, the recovery on the macro data, or at least on the expectation of the macro data, but B, the equity markets are up 40% while they had lockdowns, while they had a lot of goods not shipped out. So this is a bit of a conundrum. But the good news is that there is, outside of China, India is not shown here, but also India has strong growth. Turning back to China, you have on the right-hand side the manufacturing PMI and on the left-hand side the service. You do see that the service sector is closer to 55 than to 50, while the China is close to the level where it starts to shrink. But in both cases, the second derivative, or if you will, the slope of this curve is positive. So it's open if that is a turning point, but it's a good sign. And if you find underneath the key findings, in both cases, the new work or the activity in new orders since July have on the service level and on the industrial side sharply risen. So China, from my take, is accelerating on a low level, but it's not falling into a recession. And there is a lot of different debates around, and I will show you for forecasts for China GDP in a second. But from my take, the growth situation has slightly lightened and looks better. However, there's a lot of threat around. And the biggest elephant in the room, especially for bond investors, is inflation. Here you see the Europe CPI blue line. It's about 4%. The figures will come out shortly. And underneath in bold, you see the producer price inflation year over year has already risen above 14%. This is for Germany. Germany is the fourth largest economy in the world, and it's the export champion. This data is the highest on record, and the record begins in 1977. In the 70s until 82, we had strong inflation. So even on that time, there was never such a high inflation pressure from the producer side, which we expect obviously to manifest in consumer and later on in a second round also in wage inflation. Today, as we speak, probably in 10-15 minutes, the newest CPI data for the US will be published. Nordea has in the past very well modeled the expectation of the latest releases. They do expect, based on their models, that the inflation within the next 3 months will go above 5%. As a reminder, treasury yields are below 1.5%. And there you already see the key problem for people who are investing in bonds, but we will come back to that. Why do they model that? Well, used vehicles are still not enough there. There is wage pressure and there will be a spillover. There is rents which go up. And there are negative feedback loops from areas like food and energy, which have already risen sharply. And there is pent-up demand due to the highly vaccinated population and the open up. So therefore, we must expect more inflation in the US, also more in Europe. Not to have just bleak slides, I thought, is there an area where it looks different? And this, lucky enough, was published today in the emerging Asia space, in Central and Eastern Europe, and in LATAM, we do see easing of inflation, or at least of headline inflation. But it's the only slide which is in this sense positive from the inflation area. When you boil that down, obviously the question is where we end up. And we end up in real negative yields for government bonds. So this is the German 10-year yield after taking into consideration the core CPI data, excluding food and energy. So the real figure, if you include other areas which have a huge price increase, is even lower. So you start below 3%, and as soon as the next CPI data will be published, the likelihood that this drops further, this data is unfortunately always lagged at least 1 month, we will see lower real yield. So not only you have a starting yield which is negative, you have, even after adjusting for inflation, a huge negative data. Similar picture in the US. There the figure is roughly 2.5%. However, this graph was done as well yesterday, but with the data of September. So if you take into consideration that the treasury yield is lower and that the inflation probably today will be higher, it is probably fair to say that this 2.5% negative is understating the real effect. Why I keep preaching that? Well, today was an article published from Russell Napier. He's quite a famous economist and strategist, and he basically said in a very sophisticated way that the financial repression, which I have first presented on a CBonds seminar in Hong Kong, and since then from time to time, is here to stay. Financial repression means you take away money from people who save. You push people into non-performing assets like government bonds, like investment grade bonds. After taking into consideration of inflation, you end up with negative yield. Now you still probably think, what on earth? Here you have real life data from Switzerland. You see from 1929, there was deflation and then there was inflation until recently. We had a 2% inflation. Over that period, which is probably a lifetime span, so I do know people who are roughly in that age and still alive, you were to lose 86% of your purchasing power. With the rule of 72, in the title you see 2% inflation. In Switzerland, we are at 1.2 roughly, but in Germany above 4, in America probably above 5. With 2% after 36 years, you have half in your purchasing power. If it's 4%, obviously it takes only 18 years. And if it takes 18 years, you can break it down how much you lose every year. And that's an awful lot. Therefore, you should definitely care about inflation, and you should definitely care where to deploy money to protect you from that. US high yield is an obvious example, but the bad news is after taking into consideration inflation data with the bracket, it excludes food and energy, you end up with a negative yield of roughly 3.35%. So I buy American corporates in a junk area and I lose money. This is not normal, and obviously it's not sustainable, and it destroys your wealth. Here you see the global market in terms of spread. So you see the lowest spread, so the least yield you get in LATAM, and the highest is globally, including Asia. But even the global, if you include everything, 3.8% rounded is not much, plus the basic of the relevant government bond. And to make matters worse, so you lose already money. When you invest in nominal terms, you are around zero or a bit above, depending on the currency in the region and on the rating. After inflation, you are negative, but across the globe, with excluding China, Hong Kong, and at the moment postponing the UK, but that might come in 1-2 months, excluding at the moment, obviously, the ECB, which might wait till 2023, and the Fed, similar picture. We have and expect rate hikes. We had already 70 rate hikes and more is expected. This is a chart also from today. That means you not only lose as a starting point, but during the holding period with rate hikes, yields go up and the price of your bonds drop much further. So definitely a very bleak message for bondholders at the moment. If we look then again at inflation, but this time in China, as we go now back to the core China, you see CPI 1.5%. Well, it's a high figure. If I look at the white line here, I would say yes, it's higher than expected, but it's still contained. But the real story is also here, not just in Germany, not like in America. also here, the PPI is up more than 13% year over year. And that's huge, definitely huge. And we buy this product, so the input factors are rising, therefore the price of the product will rise, and therefore our purchasing power is also threatened from that angle. And the question is, how is the growth outlook? For China, I'm slightly more positive than the red line of GS, but definitely the growth will be around 5% or lower. So with CPI at 1.5, okay, still real growth. If I take PPI into consideration, looks a bit worse. I'm not so convinced that there won't be stimulus in China, or actually I'm convinced there will be stimulus. However, it will be most likely on the fiscal front. So now the key question is, are Asian and in particular Chinese emerging market corporates in the non-investment grade area attractive? If you look at the white line, which includes everything besides property, you see there was no much spread widening, and you get roughly 2 to 250% basis point more yield than comparable bonds in the US market. But the problem is the blue line. This chart is already 2 weeks old, so you see we had a blow up of the high yield spreads. I happened to find the same chart in Bloomberg, which I managed to update. So the chart was produced in the middle of last month. That is where we had this red circle, which was a record. However, in the meantime, we had a mini relief rally, which we actually used to sell some bonds which were hit a lot. But since then, we are back to that level and have even overpassed. And now it's the question, is that overdue? Are there opportunities or are there only threats? Bloomberg says if on the onshore market, there are a lot of opportunities. Actually, the default ratio in onshore is no stress. And also in the A-rated bond area, there is a bit of stress, but the local bonds are okayish. But the offshore markets, so where we can invest, has a lot of stress. The reason why the stress is rising was this publication. This is the year-over-year change in the contracted sales, so of flats and houses the Chinese guys buy. And here you have the main players. Most of them are BB+, some are investment grade. And look what happened. Year over year, with 2 exceptions, a huge drop. So that caused the recent last 2 weeks second sell-off. Country Garden is a very well-known name, investment grade. We will go to Agile, we will go to Sunac. Sunac is state-owned. Chimao is a very solid name. It's almost at the bottom of the list. Real default rates, actual roughly 9 billion. The market was pricing in at the middle of October more than 30 billions. In the meantime, we have risen higher. I don't know how the metrics exactly would turn out, but we can assume that it's more than 40 billions priced in. To my knowledge, there was no further default since then. This week, Evergrande has to pay another coupon, so it will be tricky. But so far, the real life is we are roughly at 9 billion. You see here how much coupon or refinancing in November will be done. And this is a huge litmus test this month. After this month, we will probably know more in detail if these are opportunities or if there are more threats. And even if the answer is to the left or to the right, in the end, you are choosing companies, bottom-up stock picking in terms of corporates. Here you see the same data in a different way. You see it with risk return. And I said we turn back to Agile. So you see there on the top in the left-hand corner, you see a 6.7% Agile bond. It's not written when it matures, but let me tell you, it will be March next year. And you see the risk return, you see it from other bonds. Let's dive into it. And again, this is not a buying recommendation or a selling recommendation. This is just analysis. The bond has dropped within 4 weeks from roughly 100 to below 70. You see underneath on the right-hand side, 1-year default risk distribution expectation. We are in the riskier part. However, I remember when the shale gas area in the US was there, most bonds didn't default. And if you look above, this is a model Bloomberg does, Moody's does something similar, derived from the equity market. They derive a probability of default. The ratio has risen, but still it is open. And if you turn in the middle, you see what the equity guys tell you. And the equity guys tell you more than 55% are in a buy, 2 are in a sell, and let's say the holds are also sell. So, but there is more positive than negative expectation. The aggregated return potential for all analysts, including the holds and the sells, is more than 100%, although the expected growth is minus 50% roughly. What it means is the equity guys compared to the credit guys have a complete different assessment. We will know in March who is right, but by definition, both cannot be right. I think it was Standard & Poor's, they have recently published a report basically saying that the company has more than enough cash to satisfy all the cash needs for coupon payments and refinancing over the coming 1 to 2 years. So here is the layout. If they do not go bankrupt, that's a great buying opportunity. But obviously, the risk, which is the market pricing in, is high. And now look at this. This is from the Financial Times. You see Agile was circled on purpose. There are 3 criteria how in future you can grow your debt. And if you are fulfilling the 3 criteria which are labeled above, then you are a green company or a yellow or an orange. And depending on that, you can still grow with more debt, or you are limited, or if the red one, you cannot increase your debt level. Turning back to the starting point, and this graph is really not old, it's roughly 2 weeks old. I see here a lot of names, which Sina Ocean as an example, Shimao. If you remember the chart from before, where to find it? Oops. So we have here Shimao, we have Agile. They are at the bottom of the list in terms of sales growth, but at the same time, they have more than enough cash to survive. And most of them, but not all, and that's the problem, they will survive. Some of them are even investment grade, like Country Garden. Underneath, I gave you also prices of another Agile bond, which matures in August. Also, that one you buy at the ridiculous price of below 80. But the risk is huge. And if you look on the left-hand side, we remember all painfully Evergrande. Evergrande was already at that time and before, obviously, in the orange area, but it was definitely not red yet. And Evergrande is not yet officially defaulted. They have even restarted building houses, and they repaid the delayed coupon. But obviously this week we will find out how it looks like. here is another Agile bond, the one I mentioned before. So it was dropping below 80 within no time, but since then it has even dropped further. This is one example, but there's an even better one. Sino Ocean is state-controlled and state-owned to 30% roughly, has 40 times more cash than Evergrande, is not at risk at all, at least to default due to liquidity. But look where the bond is priced. And therefore, if that one is not going bankrupt, and even if it were to, maybe the state will really come in, that's a huge possible return. Repeating, this is not a buying recommendation. It just shows you, if you are a risk taker, if you are able to size the poison, the risk in the right dimension, and to diversify it in a diversified bond portfolio in Chinese property bonds, on average, you will do great. But due to the lack of good governance and accounting system, we cannot know which one will default and which one will not, because the credit metrics of these examples, also Greenland is here orange, but in this case, Moody's has written a report in August, basically stating, yes, Greenland has certain risks and is only fulfilling one of the 3 criteria. However, they have enough cash for the next 48 months. In the meantime, the Greenland bond dropped to 43, has to recover to 65 roughly, and is now hovering around there. Does it go bust? We don't know. It is definitely a huge risk. But Greenland has a similar price to Agile, which is green, has a similar price to Country Garden or to Shimao, which are definitely better quality. Or you see here, Sino Ocean is even investment grade, but trades like junk. So if you have capability and resources to do your homework and to pick your individual bonds, and you find them all on CBonds, there is a huge opportunity, but there are a lot of threats, and there will be accidents, and there will be accidents on areas which you cannot foresee. Where shall you invest given this rather bleak outlook? If Mr. Napier is right with his forecast, he basically says that the financial repression, the compressed yield, the manipulation of the yield by central banks and the state will last for at least 15 years. Inflation is here to stay. If you look at this landscape, and if you have and want to invest, probably emerging market high yield is the best, safest, in brackets, safest place at the moment. While in the US, I would say there the research is the best. You can be quite sure about defaults, but adjusting for inflation, you lose money. Similar, obviously, in the euro area. Asia is, on one hand, offering you tremendous yield, tremendous opportunity, but at the same time, it offers you a lot of threats due to transparency. So if you are continuing to invest into bonds, you should definitely think about an allocation to higher yielding bonds, but at the same time, you have to have risk control, you have check and balances, and you have to be able to survive a default. The summary of Morgan Stanley, reasons why high equity markets offer good risk return right now. Right now means 2 weeks ago. Well, the valuation is cheap. Pricing has priced in all the downside. Actually, they were pretty wrong about that, because since then we have dropped another 5 to 10% depending on bonds. We do believe that the default risk is in real terms lower than what is priced in. The technical of the market looks for a rebound, and Morgan Stanley expects more monetary easing. I really hope that they are wrong, because monetary easing is not really doing the trick. You need fiscal stimulus, and you probably need support of certain companies that they will survive. Having said that, most likely there are opportunities in this area. Personally, I would invest also in other areas like commodities. We go here fast through because this is a bond seminar. What copper is needed for electrical vehicles is or has had correction period since roughly June. Goldman Sachs expects the price of commodity to go to 15,000, and Bank of America speaks even of 20,000 over the next 4 years. If that's going to materialize, obviously copper mining or products on copper will do well. My personal favorite high risk is, if you really want to be carbon neutral, solar, wind, and all the other alternatives will not be sufficient because the battery power is too low and the production capacity will be too low. Very controversial is uranium green. If you ask a physicist, he will tell you yes. When you produce electricity with it compared to oil, gas, etc., no emission. If you ask a normal person or the German government or the Swiss government, and they will tell you, well, this is actually a dirty energy sources because the waste at the end. The jury is still out. Fact is that uranium has, after a 12-year bear market, started to rise, and uran mining, here shown 2 ETFs, they have surged, really surged, more than 170% in 1 year. Oil is probably going up further because of the demand, the seasonality, but I would not recommend to buy ETNs, or ETNs which track oil price, because they are in futures. Futures are in contango, and the contango means that you lose when you roll. Oil is obviously not ESG compliant, so if you are following ESG concerns and restrictions, this is no area, but nevertheless, oil and gas producers are in a divesting phase. They pay a high dividend and they have protected you in the past from inflation, and we do expect that over the mid-term, not long term, because oil will have a lot of headwinds, but over the mid-term it could protect you. Here you see the estimated increase of demand, and you also see, or at least you can read, that we are now on pre-COVID levels. So the consumption of energy is now at levels where we have been last year in January. Gold hasn't worked. We all know that. Reasons you see here, last year after COVID, a lot of people bought gold physically, and even more bought it in ETFs or ETNs. In the meantime, they have dropped it. Most of them have bought Bitcoins or cryptocurrency, if you will. However, at least until yesterday, gold has done another attempt to break out of this trading range. I really don't know when it breaks out. It's hard to see a trigger. In theory, inflation is here to stay, and gold will protect you over the midterm from that. If that's going to happen now, if it's going to happen in 12 months, nobody knows, but physical gold can, and I believe will, forward-looking, protect you from inflation, at least partially. Last but not least, I'm not giving any advice on Bitcoin, but knowing that there will be always questions. I had this chart in previous presentations, and basically what I said before, I believe, given what I hear from the community of the crypto asset guys, we go first to 60, then break above, and next stop 120,000. In the meantime, that has happened, at least the first part of it. If the second one is going to happen, nobody knows. But if I have to bet, and I repeat, to bet, because I cannot evaluate Bitcoin, it's going probably more up than down over the coming months, and therefore it could be, but really could be, for people who want to gamble, and I repeat, gamble and not investing, a place to invest. There are long short guys in the market. That's a different animal that might work, but just to be straight long is for me a gamble. So with that, let me summarize. We have seen significantly spread widening in the Chinese corporate market, especially in the real estate area. I believe there are a lot of opportunities, and on average, you will make money. But the key and the tricky bit will be to pick winners, given the information, given the accessibility, given the erratic development of the government, which sector, which company they regulate. I believe that we will face for the Fed, for the ECB, problems that they might be behind the curve at the moment. At least in the US, we see an acceleration of growth. The Bank of England has badly surprised because they didn't raise rates. However, it was expected that this will happen. Across the globe, we have seen more than 70 rate hikes, and we expect more, as I've shown. But the key message is, I strongly believe, and I really preach that since at least March this year, inflation is here to stay. This word transitory is can be interpreted in different ways. The latest one of Mrs. Yellen was, well, at least until mid next year, 4% is reasonable before it might then come down because it's transitory. Nobody can know what will happen until then. But with that statement, basically, she says inflation is sticky and will stay on a higher level than we were used over the last 12 years. And with that, obviously, we are back to everything which has nominal yield is threatened, normally offers negative real yield. The impact of the government to transfer wealth away from savers, away from the private sector to them is here. That is called financial repression. So you put on one hand inflation up indirectly, obviously. And on the other hand, you force insurances, pension funds to buy government bonds, which deliver you negative real return. And you steal it from the people who have an insurance there or their pension there, because even if you get nominal the same amount, I've shown you the example, you definitely lose purchasing power quite quickly with 4%. Important is that we see more fiscal stimulus. This we have seen. That has two effects. On one hand, it gives growth, it helps to survive companies, but on the other hand, it will also create more inflation. On the bond area, we are where we were in spring with one key difference. Inflation is now much higher, so corporate high-yielding bonds do offer you nominal positive yield. Unfortunately, most to offer you negative yields, and if you consider inflation. We believe that in Asia, there are opportunities, in particular, which I covered today in more details in Asia, in China. However, there are other areas. Last but not least, if you are willing to accept real negative yield, we still believe risk return is quite decent in US high yield. Areas where we wouldn't invest at all is cash, for obvious reasons. Of course, you need as much cash as to fulfill your cash needs, cash flow, payments, etc. But apart from that, cash is in brackets trash. It will cost you money. The same holds true for investment grade bonds and for government bonds. I have said where you could invest, so mining shares, energy, industrial metals, gold. I didn't mention REITs. You could also consider old-timers, art, but these are areas where it's really hard to sell when you want to realize the gains. But these are real assets which could protect you from inflation. Equities are also an area, but there you have to be selective. And I can say more about it, but this is not about equities. With that, let me quote Baron Rothschild. I mean, I prefer the German version, but the German version is basically buy when the cannons are still firing. However, it seems the original statement he made was buy when there is blood in the streets, like now in, for instance, Chinese property bonds, even if the blood is your own. I mean, a disclosure, we were invested in certain bonds. In a multi-asset portfolio, we are above zero, but it would be a lie to say that we made money with these corporate bonds in the property area. Last but not least, if you are interested in more pronounced views on all asset classes, feel free to follow us on my Telegram channel. The Telegram channel is called Dr. Bickel Knows Best. Marketing guys did its best to promote it in terms of the title. Nevertheless, feel free to join. With that, I have come to the end of the presentation, and I would like to open it up for questions. Thanks a lot for listening.
Thank you very much for your comprehensive overview. We basically had made the dynamics of changes in bond market, in equities, even Bitcoins today. So we do have a few questions in the chart. And actually, it is really nice that the first question is about credit ratings, as basically that was also one of my key questions which I really wanted to ask you. So we opened the question rather open, especially for China market and for Asian market. It is rather hidden zone where whether you invest or gamble. So can we expect that rating agencies will downgrade all China real estate bonds because of the recent events and go from investment grade to junk, from junk to single B or C within a couple months if nothing changes, especially with the negative yields?
Woof, yeah, I expected this question, and it is a very difficult one to answer because, as we probably all know, everybody who follows bonds for some years knows that the rating agency are perfect in telling us after the fact / after the hit of the bond price that actually they were wrong. Well, they never say they were wrong, but they cut the rating and they changed the outlook to negative on the top. Is this going to happen in China? I mean, on average, for sure, they will downgrade some of them. But the key point is, and there we are back to where I started, do I know if examples, not advice, if Country Garden or Sunak, both investment grade, will they become junk? I don't know. I would bet one yes, one no, but I'm not able to tell you if it's A or B. And to be fair, I mean, you have the luck that now Russian bonds are mostly investment grade. However, if you see at the ratings, and you are the expert, I shouldn't even open my mouth, but just to give you the Western view, if you will, if I look at what the ratings agency, the big ones say, and then the local ones say, I see a gap. And in that case, I trust more your local guys because you're closer to it.
Exactly. I have the same opinion. You know, local guys should know more.
And sorry, one last sentence to that. In some cases, there are local ratings for Chinese bonds, at least on Bloomberg. They are similar to what I've experienced from your market or from LATAM. On average, they are 1 or 2 notches better. And most of the time, but unfortunately not always, they are spot on or better positioned than the large free rating agencies.
Yeah, well, as you can see in our platform, we have also Dagon and some other rating agencies with which are rather local. So it's interesting to compare actually their dynamics. Okay, so and as for, since we are discussing credit ratings, so what kind of credit level would you consider now like a starting point when you consider investments? I mean, your example was like BB minus with Aguilar. So what kind of, if we consider like B plus area, starting from this point, would it be okay, or it is a high risk that they will be downgraded really soon?
I mean, not knowing what the agency will do, but I would look at things which have investment grade. So one is Country Garden as an example. Last time I checked, the price was below 80 or around 80. It can be that it becomes junk, but this has really a strong balance sheet. Also, the Sunak most likely, should survive and might become junk, but I would start higher than where I normally would go. Normally I would start in the BB plus, but assuming that these nice ratings are probably going to be changed to the downside, it is probably safer to start there. Unless I say I have so much money to deploy, I can make 0.5% bets, then you might do a portfolio of 5, 6, maybe more of really risky ones. And you in your mindset, assume that 1 or 2 go bust. But if you buy them at 65 and 1 or 2 goes bust and the others go to 100, on overall, you made your money. However, in real life, if you do that for an institutional investor or for a family office guy, you are history. Although the return would be great, therefore, I would stick to what I said at the beginning. If it's for an institution, if it's for somebody who wants to preserve value in this space, start with what's today investment grade, assuming that it won't be in 6 months' time. But let me rephrase it in another way. Somebody asked, do you believe that China will be bigger in 5 years, in 1 year? The answer is probably yes. Do you believe that the real estate sector, which is roughly 30% of GDP, will still be roughly 30% of GDP? The answer is probably yes, even if it's 25. And now it comes the tricky bit. We don't know which one will be in these 25. But for a starting point, if you start with the best rated, or you can look at the balance sheet, and Aquila is definitely a border case. It's really a gamble. And we will know in March. But if it's not going bust, I mean, do the math. However, if you size that bit too much and it goes bust, I don't know where the recovery value is. Is it 60 where it's priced, or is it 30, or is it 0? Because the Chinese government also said, in case of defaults, we will ensure that our local guys get the bonds, get the coupons, and the flats will be built. They didn't say anything about the international guys. And therefore, you can conclude what that means.
Okay, I'm reading a few questions in the chat as well. So speaking about the Chinese market, so basically it is more presented in terms of real estate companies. So we have a question that these companies are highly leveraged and dependent on the real estate prices. So are they still attractive opportunities, or it could be rather vulnerable right now?
I mean, are they highly leveraged? The answer depends on which part. If you remember this greenish slide, based on the criteria the Chinese government has imposed, the green ones, they are very leveraged and they can increase their leverage. But the future depends on the contracted sales growth. And that was the chart I showed. And because the figure in October was so dreadful, so falling, now they price in defaults of all the green bonds and obviously all the orange and red ones. And not all the green ones will survive, but most of them. The balance sheet, you have obviously look case by case, but given the metrics we know, for the Chinese government, they are in a way regulated or leveraged that they are okay for them. And yes, they are to a certain degree attractive, but they come with a huge risk, because if you buy an investment grade bond with a coupon, I don't know exactly, but let's just make a simple example of roughly 4.5%, and you buy it at 75. I mean, we are all long enough in this bond business. This yield has to come with a certain risk.
True. Also, one more question. So, do you expect the Chinese government will intervene at a certain moment in the real estate sector in order to stabilize the sector, given the importance of it in GDP number?
I mean, they officially said in the case of Evergrande, which is one of the richest guy in the background of China, he should use his private wealth and they will not intervene. And at the same time, they push them to pay. And somehow, actually, they have intervened, because they told the banks that they can still use the loan. They should not cut the LTVs. So in the background, yes, they have already intervened, and we don't know when and if, but I would strongly bet that they will not let this 30% go down the drain. And not because they are so generous, etc., etc. No. Because people have bought flats which will be finished in 1 or 2 years' time. And if these flats are not finished, and on top of it, they lose their money, they have riots. And roughly 8 to 10% of the population is in the party. So having said that, 90% are in brackets free citizens, in brackets. Nevertheless, this is the biggest threat of the system. If there are riots, not just in one city, but across the country, and therefore they will do everything to prevent that. That doesn't mean that they will protect the foreign investors, because they couldn't care less about the foreign investors, but definitely for local guys. And now the tricky bit, if you are from abroad, which one of the international bonds will survive?
That's basically the answer to one of the questions. So we did had a question in the chat that Chinese government helps a lot local investors, but leaves foreigners rather helpless. So the question was, is it a reality? Seems like yes. So let's see which bonds, how would you evaluate which bonds will stand? I mean, a few criteria on your choice.
I mean, I would start obviously with the balance sheet, how much leverage there is, and I would try to find out how much free cash flow they generate. You find that on Bloomberg. I'm not sure if you have the data on CBonds too.
You can check IFRS reports as well.
Yeah, but now it comes the tricky bit. Most of them, they look pretty good, but you don't know if the figures are cooked or not.
Exactly. So this is also a rather tricky area, which is why, for me, Asian markets are still rather unknown story.
Sorry to tell you, for us in the past, your market was as well the same, and now you are investment grade. So yes, I mean, this is a high risk. It's a high controversial, and do I trust the Chinese government? No. The only thing I would like to add, that this regulation we see now has happened in the past. In the past, they did regulate other sectors, and they hit them as well. What you cannot know is which sector is next. I mean, the real estate sector is probably plus minus known, the threats, but there will be probably more regulation.
Mm-hmm. Well, seems like Asian story is pretty much discussed. So let's summarize probably on the global market. So which markets you still think are worth consideration for investors? So for instance, Latin American markets, they are pretty popular. What do you think about them as of now?
Yeah, I mean, the yield is unfortunately low, but in Brazil, disregarding the problem with the government and the COVID situation, they look quite stable. Of course, the yield is extremely low. We have problems in Mexico. The outlook of the economy looks okay. However, certain companies, especially in the credit leasing area, Crédito Real as an example, they have dropped like a bomb because there was a fraud in the sector. And I would go probably for certain state-owned companies in Brazil. The best research market is obviously the US. You still get higher yield than in Europe. Europe had, by the way, a very good year. But forward-looking, if I am going to invest in bonds, I'm probably going to buy US, some Brazilian, and where I can, and where I have a large enough pool of assets, I might add a tiny bit of these Asian bonds. But wait a second. But the question is, shall you not diversify to certain other areas? And it doesn't have to be equities. That's why I included the other areas.
And what do you think about high yield in euros? Does it still exist? Because that was my really last question a few days ago when one portfolio manager said, I'm having high yield portfolio only in euro.
I mean, that person is a lucky person this year because he had a tremendous return. But are these yields you are getting, and I showed the chart, it's the lowest in the high yield space, really worth taking the risk? Because in the end, you take an equity risk and the return, if my memory is not completely wrong, 2.5 or 3%, while the inflation is 5%. Yes, that is a market. I personally believe in euro after the rally, the risk return is not really worthwhile. And on the other hand, if this inflation theme is transitory, like the ECB keeps telling us, like the Fed keeps telling us, so in 1 to 3 years' time, you probably have again decent returns, but in the meantime, you definitely lose after inflation some money.
Okay, Andrea, thank you very much for your time. I think we'll still have one more meeting as usual to sum up the year. But let's see. I hope our plans will make true. Thank you very much for taking time to share your opinion, how we are going and which markets could be more or less interesting right now in terms of high yield. And now I would like to pass the floor to my colleague Alessandro Lombardo, and we'll try to see where and which ways are possible to find some high yield bonds.
Hi, hello everyone. Hello, thank you very much, Lana, and thanks also to Andreas as well for his extremely interesting presentation. My name is Alessandro Lombardo. I'm the co-head of CBonds International Department. I work with potential CBonds clients and current clients all over the world. By the way, I see that we have today a lot of current clients following our webinar, and that's very, very good. And now we are going to present basically the main tools of the platform. My colleague Lana will do this in a few minutes. I will just make a brief introduction of what has been done and what we are doing right now to add, let's say, values to different kind of investors. So let's say, I will just say a few words regarding what has been done by our team also this year. First of all, we incredibly strengthen our bond coverage and our research and analysis tools in general. So basically, we currently provide detailed information on over 600,000 bonds from 180 countries. This is quite interesting as it's one of the most comprehensive coverage we provide in general among all the kind of data providers all over the world. So we have now 100% coverage of all the Eurobond markets. So it's a full coverage of the Eurobond market and more than 300 primary sources of prices among stock exchanges and OTC market participants. So basically 50-50, let's say. We now also fully cover the equity market, and we are going to add as well the ETFs to our database. Let's say that, of course, the bond coverage represents the most valuable part of the platform, but it's very convenient for investors to check also other assets in one single platform, which is very easy to use, let's say, and very convenient. We are now really able, with the tools we have, to satisfy different requirements of different investors' profiles, from retail investors to financial consultants, from portfolio managers of asset management companies to bank back offices. So let's say that the need, all the requirements can be satisfied with the different kind of service we provide, because we provide, for example, the web access to the information. We provide also the Excel add-in extension to visualize data directly from Excel, and also the API services, which is one of the most let's say, convenient ways to receive our data feeds in a structured way. So basically, you pay for what you require. Now, Lana will present the main tools available on the platform, but we also invite you to organize with me and Lana, of course, a face-to-face meeting that we can schedule via Zoom or Skype or what is more convenient for you, to discuss your personal requirements. So basically, we are usually able to be very, very flexible to find a solution for any kind of request. So if you are interested, just drop us a line. We're going then to leave also our contacts, of course. You will receive an automatic email with my email and Lana's one at the end of the seminar. And we're going to be very happy to schedule a meeting together. So now you can all enjoy Lana's brilliant presenting skills.
The main question is where to get these high yield bonds, or in any case, where you are able to compare different markets and choose your own strategy, where you are able to verify some information and find probably your prospectuses in order to pass the compliance, and just to see all your covenants, just to have your kind of like insurance and some financial reports. So I'll be pretty short in terms of the demonstration. It will be sweet and rather user-friendly in terms of our platform. So the main functionality, which I think should be in your hands, is the bond screener. Since if you still are not familiar with our tools at our new platform, so you can check all our upgrades. As of now, it is very convenient to check each market. You are able to visualize all the preferences, and basically you are able to put your criteria in terms of yield, in terms of rating, and just interestingly analyze it. So I just had a chance, in order to avoid some time, pause. So for instance, you can analyze Asian market. I shift the yield starting from 3 up to pretty much high with mid maturity, and the starting rating level is WB minus. So you have the possibility to have your list of bonds. Each bond has all your criteria, all your preferences. You can basically specify whether you want to have some particularly type of the bond, or you want to exclude, let's say, subordinated bonds or any callable bonds if you want. So you have very convenient list of bonds with around 60 descriptive parameters, which you're able to download in Excel and of course analyze it in a structured way. But I would like to show you a very interesting functionality which we recently added. You're able to visualize all your bond search results on the yield map in terms of yield and duration. If you want, you can just enlarge some part in order to analyze some particular duration, let's say. You can add your benchmark, let's say UST, in order to see where these bonds are corresponding. Or in case you already have your benchmark or some bond which you refer to, you are able to add some point at your preferences right here. If you deal in different currencies, you are able to put any benchmark. It could be gilts, bonds, as you prefer. So very convenient that you are able to go directly to this page and analyze all the parameters. In a very structured way, you have all your bond data. You're able to save it in PDF to make your nice reports or to send to your clients. or if you like old-fashioned way, sometimes I just want to relax and look at the paper. So you can use all our analytical tools, which are represented on a single page. So you don't need to go back and forth in order to calculate your yield to maturity, accurate coupon interest, PVP, convexity, any parameter which you need, or just simply just a price. As of now, the crucial matter is prospectuses, final terms. So feel free to check our coverage as it exceeds rather reputable data sources like Bloomberg or Reuters, pretty much in 25% or something like that. So you are able to analyze the dynamics of changes of price. As I already mentioned, CBonds is a data aggregator with 20-year history. So the historical archives of prices and yields are rather big. So you're able to visualize the dynamics of price, yield, spread. Now you are able to compare bonds and indices. Let's say if I want to compare, so we are now at Alibaba bond. Let's compare with CBonds Asia corporate high yield and yield to maturity index, in order to see where this bond corresponds among all corporate high yield bonds at this situation. You are able to visualize and compare a few bonds, for instance, and see the spread between them. As we already mentioned, we provide the prices from around 300 sources, 50-50 from stock exchanges and market participants. So you are able to see market participant quotes and end of the day quotes from all the stock exchanges, including FINRA, trace and fee disclosure. So basically that's how market participants actually close their deals. In case you have interesting corporate who has bonds and equities on their balance sheet, so CBonds provides information on stocks or equities as you prefer as well. So this is very convenient to analyze the total depth of this issuer with the turnovers and see. As we already discussed with Andreas, right now it is very crucial to monitor the situation from rating agencies. So here you get the updates 4 times a day. So you are able to track all the situation in order to see how these bonds are performing. And of course, you can check their financial reports in order to see the situation with the market. And as the indicative thing, you can see the institutional holders of these bonds. So usually funds who invest in such bonds are have some policy, I hope so, and you're able to see the appetite in the market for such bonds. So having said that, you are able to track all your bonds which you have. As of now, you can set the alerts, for instance, in our watch list in order to have a hunt on bonds. So you can set your price yield alerts, and when the bond hits certain point, you're ready to buy or sell bond, you'll be warned about such things. In any case, if you're interested in more detailed presentation or you have some questions in terms how to find some bonds, if you have some difficulties in monitoring some markets or just want to improve your portfolio management tools, feel free to contact me and my colleague Alessandro. We have different solutions starting from just a subscription to the website with the very convenient tools like mobile app or just web access, or you can have more customized solutions and automatic way of receiving bond data via API or just ready-made Excel files. All right, in case you have some questions to me or Alessandro, feel free to write them in a chat or feel free to contact us personally and we'll answer all your questions. In case some participants were not able to make it, this webinar will be available at the record tomorrow. So, and you can see and ask us for materials in case you would like to review this event a bit later in more convenient time. All right, thank you very much for your attention, and it was a pleasure to have you with us today. And wishing you smart investment decisions.